He's credible because he's wearing a tie.
Yeah. Hey, Brian Armstrong. How are you doing, brother?
Brian Armstrong, you look fantastic.
Yeah. What are you testifying today?
I'm doing great. It's not Montclair and it's not Laura Piana, but normally I just wear the black T-shirt and the hoodie. But when times like this, I got to go talk to media, policymakers, regulators, and it's a good time to spruce up the image.
This is a week to break out the tie.
Yeah.
Hey, listen, Men's Warehouse, it never looked better. You look great.
Thank you.
I see a red tie and I think fiscally responsible.
All right. I guess, Brian, just to kick it off, FTX in spectacular fashion blew up this week, and it's pretty gnarly. You run an exchange as well. What's your take on what happened with FTX? And then what is your position in terms of making sure your customers understand that Coinbase is not going to have a similar fate to all the other exchanges that seem to be blowing up every couple of months?
Yeah. Well, first of all, I think we were all shocked that somebody like Sam, who seemingly is so smart and capable, ended up in this situation where he appears to have done something quite unethical and illegal. So, my job right now this week has been to go out there and just help people understand that Coinbase is not like that. We've been pursuing a different strategy for the last 10 years. We're a public company. We're regulated. Our financial statements are audited. They can show that, customer funds are segregated. They're backed 1-to-1. We're not investing customer assets without their explicit direction. And so that's been the first step, is just to make sure people understand that. But then after that, we need to kind of think about how we go forward as an industry here and both take a long-term perspective, make sure the good companies in the space aren't allowing one or two bad actors to kind of mess it up for everybody else. And then it feeds into the whole regulatory story too, because companies like Coinbase are already regulated, but we're regulated like a traditional financial service business. But we don't have clarity about the crypto specific regulations, like what's a commodity, what's a security. And that lack of regulatory clarity, I believe, has pushed a lot of this business offshore to these less regulated exchanges. That's part of what caused the blow up today. They were based in the Bahamas, and there's not sophisticated financial regulators overseeing what they were doing.
Brian, there's a lot to unpack, but maybe we can just take a step back, and for the uninitiated, or for the person who's only been just following this very superficially, can you just, in a nutshell, explain what happened?
Yeah. So my understanding is, and again, this is from people I've talked to, and I spoke with Sam and CZ briefly during this, but I didn't get details from them. I got it from other people.
You spoke to them this week.
Yeah. This was all going down. I spoke to Sam about, he was trying to raise emergency financing and things like that. And I spoke to CZ about why he was considering buying the asset. I thought it was a bad idea. But my understanding of what happened at this point, and again, I don't have all the facts. This is just my understanding, is that FTX was in a position where they had this market maker, Alameda, that was investing in risky things. And that's fine. Like market makers, hedge funds, they're designed to take more risk. It appears at this point that back during the last shakeup in the crypto industry where, Terra Luna and Voyager and Celsius and Three Arrows went under, it appears that Alameda took a big loss at that time as well. They may have even been underwater. And instead of just saying, hey, this hedge fund's going to blow up too, which would have been unfortunate. People would, Sam would have lost money. It's embarrassing, but it's not illegal for a hedge fund to blow up. It happens with some regularity. Instead of just letting it blow up, it seems like at this point, he took customer funds.
Wait, you have to explain. He owns both. That's for the people that may not understand that. Yeah.
Right.
So it's a related party.
He owns his own exchange called FTX, and he owns his own hedge fund called Alameda,
which operates inside of FTX as well as in other places, right? But again, Alameda seems to have blown up. Sorry, Brian, back to you.
Yeah, so it seems they had this solvency issue, and instead of just letting it blow up, Sam basically said, hey, we have a bunch of customer assets over here at FTX, or he somehow basically made a loan from FTX into Alameda to try to prop it up. I don't know why he did that. That's the moment in my mind where he crossed the line into probably committing fraud. And I think he probably lied to users, lied to investors, and he went around and tried to bail out these different companies like Voyager and BlockFi and to sort of prop up this thing. And maybe he thought he could trade his way out of it or something. I'm not sure, but that seems to be where the mistake was made.
Brian, can I ask one question, which I think will help frame the contagion risk set of questions that everyone's having? When people have an asset, we all talk about customer deposits and customer assets held at these exchanges. but those assets and those deposits are very often some form of coin. I have some amount of Bitcoin, some amount of Ether, some amount of something else. Is it the case that there is an assumption of total asset value that's held in a portfolio of coins that doesn't necessarily match the individual user's accounts? And then when one coin goes down in value nominally to dollars, that the whole value of the portfolio goes down, and now you can't actually make the customers whole. So in the statements that have been made by these guys and other exchanges that we have enough liquidity to cover customers' accounts, that the assumption might be we have enough liquidity if you assume the current market price for a whole bunch of different coins. But then if one coin tanks, the total liquidity tanks, and they don't actually have it matched up correctly because now the customer account value didn't go down as much as the exchange's total asset value. Does that make sense?
It does. And
is that part of the contagion risk that's going on here? Is that they're not matched truly between customer accounts and the exchange's holding of coins?
So not exactly. Okay, so if you're a regulated financial service business, but you're not a bank, we're regulated as a trust company, a money transmitter, et cetera. You're required to hold customer assets one for one, denominated in the asset. So in other words, if you say the customer has one Bitcoin, you have to hold one Bitcoin. If they say they have $100, you have to hold $100. And so that's the case with Coinbase. You don't have to take our word for it, by the way. You can look at our audited public financial statements as a public company with an independent, Big Four accounting firm who went to go verify all of that. And that's what various custodians and exchanges, that's what they all should be doing. By the way, if you're regulated as a bank, you can actually go invest some of those, but there's very strict regulation around that and capital requirements and whatnot. And we're not a bank. So we hold one-to-one. Now, if you're an investment fund or a hedge fund or something like that, then you can try to take positions in different coins and different assets, and they could go up and they could go down. You may lose your investors' money, but there's no such thing as the customer assets being involved in that. There needs to be clear segregation of those customer funds and from what an investment fund would be or corporate funds. And that's where they got in trouble. They basically commingled customer funds with their hedge fund.
Classic fraud.
Yeah. Can you explain the contagion, by the way, just so we can, because everyone's been talking about the contagion and understanding what's next. So that's what I just want to, because I think people are going to be asking that a lot this weekend.
Yeah. So I do think there is some contagion risk here. I think there's other firms that had, first of all, there's firms that had money just sitting in FTX, and that's now going through bankruptcy court. So that's been bad. I mean, Multicoin came out publicly and said that they had 10% of their portfolio sorted on FTX. There's other firms that Alameda may have had loans with, and those firms are probably struggling. I don't want to say who, but we have received a couple of inbound calls from other people trying to get emergency financing. There's people who may have just totally different from FTX and Alameda. They may have just had their own portfolio that they took margin or leverage on to buy crypto. And now as the prices have come down a little bit, they're getting stopped out. So that's all been very challenging. And I again, just for the sake of clarity, I should say that Coinbase did not have any material exposure to Alameda FTX or FTT token.
Can we just talk about this issue of customer deposits? Because this is really the crux of the issue from a legal standpoint, right? I mean, I remember when I was doing PayPal like 22 years ago, and the company was like 6 months away from running out of money. I remember the lawyers told us really clearly, you cannot use customer deposits to fund the operating expenses of your business. In other words, if this business ends up going bankrupt, you'll still have all the customer money there and they'll be able to get it back. And, it was really clear, like, hey, if you use customer funds to pay for the burn of the business, to operate the business, that is a do not pass go directly to jail type offense. And so, like, that's really the heart of this. Now, I read in some articles covering this that the way it worked is that Alameda had a bunch of these FTT or these FTX tokens called FTT. And they basically use that as like a marker, as collateral. So that they basically borrowed, like 6 billion of customer funds from FTX. And then they use their own token to then as collateral. So
to backstop it.
Yeah, exactly. And then what happened is apparently like CZ got wind of this and he owned a whole bunch of these tokens and he signaled that he was going to dump it and the price basically went down. And so now all of a sudden the collateral for the customer loans was insufficient. And then there was a run on the bank. And
by the way, this happens in the public markets a lot as well. So like when you see heavily shorted names or when you know that certain hedge funds are on the brink, other hedge funds will go in and essentially force a margin call and a stop out, because then it's what causes all of these runs. And if you look actually inside of GameStop, the reason why you got all this gamification in the GameStop equity and a bunch of these other names was in part because of this dynamic. Folks that are highly levered, folks that don't have the right matching of risk. And what happens is they're solvent but illiquid. And then if you run the instrument into the ground, they both become insolvent and illiquid all at the same time, and the whole thing explodes. So, Brian, the question is, now that we know what happened, which is all of these crazy inter-party related transactions, and all of this stuff seems very illegal, there was a bankruptcy filing today, and up until today, it seemed like this issue was really about FTX International and Alameda, and it didn't touch FTX US, which for a long time tried to position itself as, well run and regulated as Coinbase. To be, they tried to say that. But now, if you look inside the Wall Street Journal, all the articles say that this is actually FTX Group, so the whole thing seems to be imperiled. Can you just help us explain that? Because now that's a lot of US people that were following the rules, thinking that this thing was matched one-to-one, that may be also affected.
Yeah. So, look, I don't know who inside FTX's and its orbit of companies actually knew that the fraud had been taking place. It would not surprise me. I have no idea, to be honest, but it would not surprise me if FTX US people and employees had no idea that this was happening. I'm imagining if Sam was doing, when he started doing this, he probably wanted to keep it to a very small group. Otherwise, this is the kind of thing that leaks and the whole thing blows up. Now, that being said, I don't necessarily think FTX US is worth anything as a business right now because of the brand being so tainted. And there probably was not great separation of these entities in the sense of, did they have truly separate boards and beneficial owners and governance? And Sam seems to have, it appears that FTX didn't really have a CFO or maybe even like a real board or anything like that. And so it's hard for me to imagine.
We found on Reddit, there was an article that appeared that said that the head of compliance at FTX was also the head of compliance at a poker site called Ultimate Bet, which in the 2010s did this exact thing, apparently. Some version of this where they went in and they looked at hole cards of poker players, and then a few employees inside the business would basically play against these folks, knowing what the hole cards were, ran this cheat, stole millions of dollars. Somehow that person found a way to be head of compliance at FTX.
Yeah.
10 years later, which is incredible. But back to this question. So now what happens now is you have the international business and the US business and Alameda Research all rolled up into this one frozen entity, right? With now regulators having to... So do you know what happens in a process like this? Like, is it that the DOJ and the SEC get priority, or is there some international monetary, like who unwinds all of this? How do people get their money back, if at all?
Yeah, so I'm not an expert at this, but my high level understanding is that the bankruptcy courts will essentially, and I believe they filed bankruptcy in the US, which is an interesting thing. I didn't know why they did that versus Bahamas. But anyway, the bankruptcy court will basically go through and try to find any assets of value. So, I mean, they still have some tokens and value. They have a venture portfolio. I think Sam owned 9% of Robinhood. There's various things that they may own. And then they'll kind of auction those off to various bidders on distressed assets and then try to distribute those funds to the customers. I don't know the exact process beyond that, though.
I mean, if you remember, the Madoff wind down took many years. And for years, he was trying to find assets, and then he found a market, sold them. There's the trustee. I think he's still active. And then, tried to redistribute the funds. Obviously, so many more customers here than there was with Madoff, but it can be a very long and winding process to identify all the assets, then run the market sale process on them, then figure out who gets what first, and then distribute.
There was an interesting thing that Larry Summers did, I think, for Bloomberg, where he was asked whether this was Lehman or Enron. And he said, it seems more like an Enron than it is a Lehman. And Brian, I'm just curious how you think about it. Like, is this sort of a fraud perpetuated by a group of executives to essentially take advantage of a situation? Or do you think that this is more like a Lehman situation, which is a well-run business, I guess, that just got caught in a liquidity trap?
I think my guess is it's a little more like Enron in the sense that, yes, they were over levered and that kind of thing, but the minute that they moved customer funds in some way, shape, or form to backstop the hedge fund, that was, in my mind, fraud. And, that's more like Enron.
Do you think now that we have to open the gates on regulation, like the whole point of crypto in some ways was, trust nobody. And, decentralization is the key. But here, what we see is a lot of people were tricked into trusting FTX and having their deposits there. And it was a centralized exchange, which caused all these problems. So it's like, it almost violates the principles of what the whole product market fit was supposed to be. So what should sort of the observer expect? And what do you expect as a business in terms of how governments now react to all of this?
Yeah. Well, I think it's really important to distinguish between the centralized players in crypto, which are custodians, exchanges, et cetera. Coinbase has a big business there. And the decentralized players, which are, self-custodial wallets, DeFi protocols, Web3, that whole world. So the centralized players should be regulated. And today they're regulated already like kind of traditional financial service businesses. But they don't have the regulation clear when it comes to the crypto aspects. So for instance, in the US, we actually don't still have clarity about what is a commodity, what's a security, which one should CFTC regulate versus SEC, that kind of thing. And that lack of regulatory clarity, and frankly, the climate of regulation by enforcement, the negative rhetoric from Chair Gensler in particular, has created this sort of chilling effect in the US that has pushed a lot of that centralized actors' activity offshore. In fact, 95% of the trading volume in crypto is now outside the United States, and it's come down a lot since the beginning of this year even. Now, the decentralized players, self-custodial wallets, DeFi, Web3, this is where crypto really has an opportunity to make a more fair and free and transparent system, because you can go look at any smart contract to see exactly what it's doing. Anybody can audit the code. If you have a self-custodial wallet, you can just trust yourself. You don't have to trust any other intermediary out there. And that's where you get true decentralization. And I think that's actually now those areas still have a couple of their own challenges. Sometimes people will lose their password or their phone, and they'll lose their own money. So if you're trusting yourself, you still have to trust that you're going to do that piece correctly. But there's a lot of good things we can do there around making social recovery mechanisms and MPC wallets and things like that.
We remember just a couple of months ago, Gary Gensler started saying, "Hey, these things are all securities." And you went and visited the SEC a couple of years ago, or you tried to. They wouldn't meet with you. You were very public. You did a tweet storm. We talked about this on my other pod. That, hey, we want to meet. We want to talk about that. Now we're still in a position where the SEC's position is these are all securities, which means anything that's trading, it would have to be limited to accredited investors, et cetera. What should the United States do here? And how close are we to getting clarity? Because I know you're trying to talk to the SEC directly about, can we just get some clarity here? Can people buy these tokens or not? What is the status of, are they tokens? Are they securities, or are they not here in the United States?
Yeah. So luckily, since then, we have had a lot of productive dialogue with both the SEC and the CFTC and Treasury and all kinds of people in Congress. And I do think the US is making some steps in the right direction. There was a bill going through Congress recently called the DC CPA, or the Stabenow-Boozman bill, although it's having some challenges now, frankly, due to this FTX blowup, because SBF was one of the people sort of pushing that bill forward. But regardless of that, the sort of system that we should have is there should be a clear designation between what is a crypto commodity, and that can be regulated by the CFTC, and what is a crypto security. Now, this is one of those legal, and by the way, what is also a stable coin and artwork and other things that are not any of those things. The challenge lies in that there's kind of a fuzzy line between what is a commodity and what is a security. And a lot of this law is based around the Howey test, which says a security is an investment in a common enterprise with an expectation of profit. And so it's basically a point-based system. And in the absence of really getting a clear list between the CFTC and the SEC are in this turf battle, I would love it if, they could basically put out a list, get their heads together and put out a list. Hey, CFTC is going to do these, SEC is going to do these. A bunch maybe are in the middle. Let's let the courts figure that out or whatever. But that just hasn't happened. And it's a missed opportunity in the US.
So if the Howey test is not perfect, given the dynamic nature of cryptocurrencies and all the innovation, if Brian Armstrong was going to say, hey, this is in the best interest of Americans, balancing, some amount of security and safety for people making bets on this currency and allowing innovation. What would you say is the best definition, the best way for us to regulate crypto coins? Putting NFTs aside, putting DAOs aside, just specifically.
Yeah, actually,
coins.
Jason, hold on. Let me just tweak your question.
Sure, build on it.
Because we should switch to SBF as well and just talk about the person. But to me, it seems the whole issue, if you come back, like what is the first string that you pulled that unraveled the sweater, was the fact that these tokens were created out of thin air. They had no meaningful value. Somebody prescribed a value, and all of a sudden, everybody else in the economy all of a sudden said, yeah, I'll take that as collateral. Look, you cannot do that in the regular world. I can't call JP Morgan and say, I've invented this thing. It's called a share in XYZ, and I'd like you to margin loan, give me a loan against it. So, Brian, explain, there's a ton of these tokens that have been engineered, right? And there's been a ton of these tokens that have been sold. So what should people do that own these things thinking that there was going to be some safety or value or, how do you think about all of these tokens that could be as basically as fragile and shitty and worthless as FTT?
Yeah, well, there is this concept of an exchange token, and there's a couple other firms out there that have them, and that's something we haven't done. And I think you're right. The actual utility of those things is a little questionable. And so if someone's going to sort of mark those up on a low supply and then a low float and then somehow leverage that's going to get yourself into trouble. But look, I don't want to throw out the entire concept of people creating tokens. I think there's actually a lot of good stuff there. And it comes down to this idea of if you're trying to raise money for your company and through a token, that's fine. That should be a security. And there should be a regulated way to do that in the US. Go register it with the SEC, let it trade on broker dealers. That's what we've been wanting to do for a long time. And the SEC is taking their time getting there. They don't, Gensler, to be honest, he doesn't seem that excited about the idea of this whole industry existing. And so anyway, but it should exist, and it should be happening in a regulated way. So if people want to issue a token that's raising money for a company, let's regulate it as a security. If they want to issue a token that's truly on a decentralized protocol, or it has some other purpose like voting in a DAO or rewards or something like that, then that's probably not a security. And let's be honest about that and allow those things to trade in a different environment, a different regulator under the CFTC.
We're probably running out of time with you because you said you had a hard stop. So let's ask the $1 million question. Tell us about SBF. Who is this character?
When did you first suspect?
Yeah, what's your read on the psychology
that this wasn't legit?
Do you think that it was his altruistic intent that allowed himself to convince himself to do this? Or do you think this was malicious the whole way? Or what's your sense of the guy?
So again, I'm speculating here. I mean, I've spent time with him. I've met him a bunch of times, and I have to say, I did not see this coming. He appeared to me to be a very bright, credible, competent person, perhaps a bit young, perhaps, a bit reckless at times, but not unethical and not committing fraud. I definitely did not see that. If I look back to see, were there any warning signs that I should have thought twice about it? One of the things I noticed was that in 2021, Coinbase had a good year. We did $7 billion in revenue, $4 billion of positive EBITDA. We became public as a company. At that time, FTX did about $1 billion in revenue. And I knew how much money we had for our venture budget and just different investments we wanted to make. And I knew their revenue. And I had to scratch my head a bunch of times. And I was like, where is this guy getting all this liquidity? Because he was buying 9% of Robinhood. He was putting $1 billion into this. He was donating to all these politicians. And I was it did not make sense to me where he was getting all this cash. People just kept telling me, oh, his market maker Alameda is just printing cash. And I was okay, I guess, it seems like a conflict of interest to own an exchange and a market maker. That's why we haven't done it, but more power to him, I guess. And so I was surprised. I didn't speak up. I can't explain the psychology of it at this point, whether he's a pathological liar or if he's started off good and somehow under the pressure of this whole thing went bad. But the minute you can go watch the interviews, he's lying to people about why he's bailing out Voyager and BlockFi and these, and he knew at that time that most likely he knew at that time that they were not solvent. Alameda was not solvent, and so that's where he crossed a major line in my book.
And we see it time and time again. Elizabeth Holmes, Bernie Madoff. I mean, once the lie gets too big, you can't get out of it anymore. If that's the case, really incredible.
And the most important thing at this point, Brian, is that the United States makes a decision on, do we want to be in crypto? Do we want to have a say in this and create a regulatory framework that entrepreneurs like yourself can deal with? That is the most important thing to happen in the next year. But you're saying the SEC is not motivated. I guess, why are they not motivated? They're just CYA.
No, they're motivated now. This is a political issue now. So
but let's hear Brian's answers here. What do you think,
let's find out who did SBF give all this money to? Because he was touted as one of the future biggest donors to the Democratic Party. If you want signals, I would say there were some pretty big signals here. Number one, he said he's going to donate $1 billion to the Democratic Party. And he kept touting this like effective altruism, whatever, the saving the world stuff. Now, why do you need to do that unless you're reputation laundering and trying to buy political protection? Come on.
Okay.
You don't think that was a little bit of a signal?
Well, here, I'll tell you an even more explicit signal. He pitched us in that $17 billion round, and I did a Zoom with him. And after the Zoom, I'm like, this doesn't make much sense, but I'll have my team do some work. We did some work, and we sent him a 2-page deck. And we said, here are our recommendations for taking the next step. One was the formation of a board. The second was the creation of dual class stock. The third was some reps and warranties around affiliated transactions and related party transactions. And the person that worked there called us back and literally, I'm not kidding you, said, go fuck yourself. Was quote unquote the response to us. We're like, okay. So that was the easy decision, but
message received.
Message received, but I still thought, okay, I'll just put that in the bucket of these guys are unbelievably arrogant and smug. But Brian, I thought what you thought, which is maybe it's because they've created some money-making machine in the Bahamas, and so they have that level of confidence. You know, but then to see this thing to the extent of which is now, we're only scratching the surface, guys. You know, we're going to find out stuff every day.
The postmortem is going to be crazy. But Brian, to the question I asked before about the SEC and what should happen, you said, I want to pick up on what you said, which is the SEC doesn't seem motivated. Why is the SEC, in your mind, not motivated?
Well, I think you're right. I hope that they use this as a moment to come together and help, local companies in the U.S. being built here to end up in a better place. And I do believe, David, I think said it's right. It is a political issue at this point. There's going to be a major impetus to get the clarity here in the U.S. and hopefully to help build the companies here in the U.S. that are going to serve the rest of the world and in every major financial hub. So we're committed to building that together with all the regulators around the world. And crypto's here to stay. This is a temporary setback, but I'm here to keep building and make this thing happen.
All right. We really appreciate you taking the time, Brian. David, you want to get the last? Yeah, being so honest.
Listen, I mean, story after story here about, SBF was going to create this $1 billion philanthropy to, save the world, improve humanity's long-term prospects, number 2 donor to the entire Democratic Party, and on and on and on. And quite frankly, what this shows is, you want to know what effective altruism means? It means that you steal other people's money while bragging about saving the world while taking a big chunk for yourself. That's what it means.
There was a research paper in 2011, and this research team looked at drug addicts and drug abusers, 4,000 people, and they found that the biggest addicts had the highest intelligence, that you were twice as likely to become an abuser or an addict if you were any kind of intelligent quintile that they were measuring. And someone explained this to me at the time, that the smarter you are, the more you can convince yourself that when you're doing bad things, you're actually doing good things. Even if you're doing bad things to yourself or bad things to other people that you really may actually care about, you can convince yourself that there's some reason to keep doing it. He seems like a brilliant guy. I think that to some extent, he may actually, I don't know the guy, but he may actually believe that the ends did justify the means, and he thought that he was doing good for the world, and this was something that had to be done in some way, and it just got a little bit away from me, but it's still worth doing.
I think the problem is bigger than FTX, and I'll say the uncomfortable part out loud, and nobody needs to necessarily comment if you don't want to, but there were an enormous number of venture firms that talked their way into just completely doing zero work here. I mean, and the tip of the spear is this thing Who's the guy that works at Founders Fund? Zebulgar? Delian, thank you. Yeah. That tweet that he had where he basically took the snapshot of the Sequoia transcript was one of the funniest things that I've ever seen. I mean, this was a $215 million decision, and Sequoia documented it and put it on their own website. And I think that's an example of something that was happening, which is people just looked the other way and didn't even want to do the layer of work.
Chamath, let me just string together a couple of things we've talked about over the past few episodes. And I think you'll agree with this point. But generally speaking, there seems to be a very heavy lack of governance in investing, given the amount of capital and the velocity of capital in Silicon Valley, particularly in private markets of late. And a lot of the stuff that's been talked about, where last week we talked about super voting shares, and the founder does whatever they want, and there's no governance, and there's no board, and there's no oversight. And particularly with this FTX situation, where clearly there wasn't a board that was, getting the necessary information, that had the necessary influence, that had the necessary controls, the meta conversation. But all of these threads tie together the concept that maybe there's not a lot of governance and not a lot of diligence going on. And the amount of money that's flowed into Silicon Valley has allowed a lot of this loosey-goosey behavior. And
I agree with you.
Consequence of it.
Let's thank Brian Armstrong for joining us. I know it was a very busy day, and what a great, candid, insightful.
Thanks, Brian.
Thank you, Brian.
Thanks,
Thank you.
Candid and insightful. Finish with that, Chamath.
I just want to say the second uncomfortable thing out loud, which is there was a lot of venture firms in Silicon Valley in this period of both not doing any work or diligence, who also took the extra step and actually created classes and would teach teams how to create these tokens. Okay, and those artifacts, those video links and artifacts are sometimes on their website. They're still on YouTube. They're inside of Twitter. And what these folks would do, and we talked about this, the game that they played was they would get a team, they would create a token, they would also buy equity at some crazy valuation. The equity was locked up, but the tokens were not. And then they would put them on an exchange and sell them to unsuspecting people, and they would be able to dump these tokens. And if you look inside of that trend, what you're going to see, and Brian just mentioned this, those were the sale of securities, except it was done in a completely unregulated way. So if the SEC is really, and the DOJ is really going to take this FTT token issue seriously and what happened to FTX, they're going to start to look at a bunch of other tokens and token sales, and you're going to end up looking at some very well-known venture firms inside of Silicon Valley.
This is going to be super gnarly, and we talked about it before on this pod. There are people who knew better. So you get a bunch of kids who are living in the Bahamas in a house, and they're, winging this thing. That's one level of responsibility, and they'll go to jail. But when we talk about venture capitalists, capital allocators who've been at it for decades, to Chamath's point, and they're teaching people how to do this, and they're hiring attorneys and creating offshore Panama, BVI, whatever, places to put these coins, and then teaching people how to do it, and then flipping them potentially. We're just peeling back the onion on this. I have a feeling that this is going to be the turning point in all of this.
That token, guys, let's be honest, is not the only token that has been engineered by Silicon Valley venture firms. And it is also not the only token that's gone to zero that was engineered by Silicon Valley venture firms.
Well, I mean, who knows engineered by, but yeah, adjacent to at the very least.
No, Jason, there's videos today on some of the most well-known venture firm sites on how to do this.
Oh, wow. I'm going to have to see those. Yeah. So they're basically, your point, Chamath, is they're instructing people on how to do this. And that is a level of culpability.
It's what they did.
Can I ask your guys a point of view on just one big macro philosophical question? I'm obviously not big in the crypto world and haven't been, but so much of the positioning has been that these networks get decentralized through the cryptographic verification systems that obviously enable them to operate effectively and truthfully and correctly and without centralized control or manipulation. But ultimately, while these networks themselves may be decentralized, the user's point of access often ends up being centralized as a point on the network. And it is that point on the network that accrues the same level of influence, power, control, and value as what we saw in the prior centralized network model. We had Balaji on last year, and I tried to get to this point with him. We had to cut the conversation short. but I've still not heard from anyone. And I've spoken with Brian separately about this point. And the concept I use is like, look, media, if you put all the YouTube videos on a decentralized network and anyone can access them and they're distributed everywhere, you still need to have a really good application. And whoever makes the best application is going to get all the usage. And then all the users will use that application, and that becomes effectively the point of control and influence and value once again. And so it seems to me like in this case, the exchange was being used as a centralized wallet. Certainly you can do exchange through the exchange, but mechanistically these guys were storing their coins, their cryptocurrency inside of FTX's wallets. And so FTX had control over their assets. And so the network centralized. And so does the decentralized model, it's a question I'd love to just ask you guys your point of view on. Does this decentralized model actually ever manifest where everyone has their own wallet? And I know there's all these new protocols and these distributed wallets and DeFi things, but
I don't know enough.
Yeah.
I don't know
that would be
enough.
certainly better
but
than centralized.
This points out to me, just you basically recreated an exchange without a regulator. And of course, someone ripped you off and it blew up. Like, I mean, how's it any different than what we had in version 1.0? And is there really a model where decentralized works, or ultimately, because of the network effect and the economy of scale? Okay,
Chamath, answer. Yeah, Chamath, answer.
Yeah.
All right, we got the question. Yeah. Go, Chamath.
No, I mean, I don't know the answer to Freebird's question because I don't know this space well enough. I mean, my biggest purchase ever was Bitcoin in 2011. I've bought a bunch of these tokens that have massively depreciated in value. I think lots of investors have. I kind of fell into it as well. Like, I thought, wow, this is incredible. I get to buy these tokens. They do all of this cool stuff. They represent all this value. And my experience has been the opposite of that. I've lost a lot of money in these things. And so, I really hope that regulators, not just obviously, I hope that regulators do the best they can to get investors' money back in FTX. But I really also hope they figure out all these other tokens as well, because you can just rank them in terms of market cap, start at the top and work your way down. And you will see that these were unregulated securities, Jason, that were manufactured and sold by our brethren.
People who understand the law around accredited investors and the stuff very well.
Yeah.
They understand it implicitly.
Do you guys think crypto investing is dead, or what do you think? How do you think people think about that risk profile now inside of?
I think investing in the tokens is going to end. Investing in the corporation is going to begin, and any of the tokens are going to be super regulated. Building on what you said, Chamath, about the ultimate bet, is it possible that Alameda, the trading hedge fund, was looking at the FTX data, which they had insights into, and essentially that's the same as seeing the whole cards in the ultimate bet. And so they're making their trades based on what they see the consumers are making their trades, front-running their trades or otherwise.
That's not illegal. Citadel does this in the regulated market. That's what payment for order flow is. It's the ability to front-run retail volume. And so, in dark pools, that is legal by the law in the United States. And that's what allows Citadel and, I think Jane Street and Susquehanna, all these folks basically run these dark pool exchanges for regulated securities like options and bonds and stocks, and they get this order flow and they front run it by a millisecond, and they just take small vig. Okay? But
they can't print the FTT tokens and otherwise manipulate the market to the level that I think SBF could.
I just think that there's these really strict walls and segregation, as you heard Brian talk about, when you have those businesses in these regulated markets. The problem here is that this is totally
Wild West.
Unregulated, wild west. So who knows what's going on, really?
And we're pushing the business, Sachs, off of the shores of the United States. As you said, 95% of this is happening offshore. What do you think should happen regulatory-wise, Sachs, in terms of America and competitiveness? Or do we need to be competitive in this?
No, I think we should be. I mean, what if crypto and DeFi is the future of finance? I mean, it's an important technology that I think we should enable through some sort of constructive regulatory framework. I think the regulators should listen to Brian and help come up with the appropriate framework. But to be clear, look, what Sam did is way worse than people going on an exchange and speculating. I mean, look, I think that people who speculated in the buying and selling of these tokens, they were using it like a casino. Okay. Like, that's different than a customer putting their money on FTX and having their money get stolen. That's a big difference. So I think there's levels here. Now, Chamath, to your point about who's minting these tokens, you're right. Maybe that's like another category. But I do think that the reason why this is on a different level is because it wasn't Sam's money to give away.
There is such an easy solution to this regulatory environment.
I agree with you on that point, but I think don't underplay when there's an organized process to create an illegal security with special rules for them that allows the liquidity for one class of asset and not liquidity for others.
You're right. So that's a separate bucket. I don't think it's the same as what Sam did. And I don't think it's the same.
I agree. No, I'm saying
that's different types of grift.
That's something that needs to be looked at, and we need a constructive regulatory framework for that.
There is such a simple silver bullet for all of this, which is these things there needs to be proper governance. People have to have skin in the game, insurance, people signing off on the taxes, boards, onshore here in the United States. And then we need to have, and I'll keep saying this, a way for Americans to become sophisticated investors. Only 6% of this country fall into the qualified purchaser and accredited. If you want to trade in these things, or you want to trade in NFTs or private companies, we should have a driver's license-like test, a firearm-like test,
you and I are on the same
make a
side
sophisticated test and let people opt into it with an education.
The problem is when you have guys like this, it sets that desire back by a decade, if not more. Okay,
that really sucks. I agree.
Because
so frustrating.
Every single person inside of Washington right now who's anywhere near this from a regulatory perspective or a policy perspective is meeting on Monday morning. Yep. And the meeting topic is, how do we defend the mom and pop folks that lost money here?
Yes.
That's the only thing. So we took this out of, because I remember I texted into the group chat, hey guys, what do we think the legal ramifications are that drive prosecution? And one of our friends said, legal ramifications? These are political ramifications.
Yeah.
Which means that this is going to go to the utmost level and it's going to have the most scrutiny and they're going to act really quickly. They're
going to drop the hammer instead of having a path to accreditation. I agree with you. They're going to drop the hammer because their constituents, some grandma and grandpa, or some people put their college education to this and lost everything. We just need a test. Let people prove they're sophisticated and let them participate if they get a license.
JKL, haven't you been a proponent for letting people invest in startups that are just mom and pops and democratizing access?
I'm only allowed to do that with accredited investors. I would like there to be a test. And I actually teach a course, Angel University, 6 times a year for charity. I do it for charity. It's a 4-hour course where you learn about diversification. You learn about the asset class. You learn about 70, 80% go to zero. We teach you about the power law. I try to teach people about this stuff so that they can participate intelligently. It would be the equivalent, Freeberg, and thank you for asking the question. It would be equivalent if we had a poker test, and to play in the World Series of Poker, you had to go to a 5-hour seminar and you had to take a practical test and you had to say, a flush beats a straight. And you had to just prove that you had some level of knowledge of how to play the game. It's such an obvious path to removing these problems while staying competitive as a country. And instead, we're letting people do this offshore like CZ with no rules or whatever rules he chooses. It's just infuriating. It's so stupid. Our politicians in Washington are so dumb.
Can I just say something? I think the challenge is there's always a spectrum of understanding. And you'll always end up seeing the people on the wrong end of the spectrum getting taken advantage of. There's this notion of adverse selection. Distributions are not equal. People will end up, kind of opting in to spend money on things or making investments that they think are good investments, but they're actually getting taken advantage of because they're not savvy enough or they miss an important angle or important perspective about the person or the thing that they're giving their money to. Yeah. And there will always be some number of those. And the way that regulation has worked historically is not by first saying, hey, let's figure out the right way to create a framework for operating. It's that some sort of people got advantaged. That story then becomes the regulatory framework. And that story has repeated itself for 500 years across capital markets.
We're talking about a multi-layered thing here. We want to see crypto have a framework. We want it to blossom here in the United States. And then there's multiple level of people who are causing chaos in this ecosystem, in this very promising technology with their goddamn grifts. Whether it's VCs grifting or SBF or incompetence, we just need to clean this framework up. If people, sometimes people I understand in DC listen to this podcast, if they're listening, It's essential that America be competitive here. It's essential that everybody participate in risk capital and get educated. Let's clean it up and make a framework that allows all Americans to participate and educates them, and then stops these grifters from doing stupid things. If people were educated, that's the first step, and it's the best step.
Should we talk about the economy?